Russia has escalated its response to Western sanctions, warning of serious repercussions for Western assets following the freezing of Russian funds. The stakes are significant, with Western assets in Russia estimated at $194 billion. These include $32 billion held by U.S. companies and $90 billion by European entities. On December 16, 2024, the European Union adopted its 15th sanctions package against Russia, marking a sharp intensification of economic tensions. In turn, the Kremlin has enacted measures targeting Western businesses, intensifying the strain on international relations. Russia has imposed stringent controls on Western companies, including a mandatory 50% discount on asset sales to Russian buyers, a 15% exit tax, and restrictions on profit repatriation via C accounts. Additionally, over 700 million euros in assets from 3 Western banks have been seized. Companies like Carlsberg and Danone have faced expropriation, while firms such as Italy's Ariston and Germany's Bosch are now under Gazprom's temporary management. These measures demonstrate Russia's escalating response, though its full impact on Western entities is still unfolding. The repercussions are felt not only in boardrooms, but among workers and local economies that depend on these businesses. Germany, once a major trading partner, has about $17.3 billion in trapped assets. Despite sanctions, Western companies still have a significant presence in Russia, with U.S. firms holding $32 billion and European entities $90 billion. In retaliation for Western sanctions, and the G7's decision to allocate frozen Russian assets to aid Ukraine, Moscow has taken sweeping countermeasures. A decree signed by President Putin in April 2023 allows the temporary seizure of foreign companies' assets within Russia, subjecting exiting companies to heavy discounts and taxes. This has caused operational challenges and financial stress for corporations and investors alike. Efforts by Western companies to leave Russia have been hindered by bureaucratic challenges and financial losses, with write-downs and revenue losses exceeding $107 billion. Profit repatriation is virtually impossible, as companies are required to keep funds in Russian-controlled accounts. Moscow's recent warnings of retaliation against Western plans to seize Russian assets signal heightened tensions. Russian officials have described these actions as illegal and threatened unspecified political and economic countermeasures, leaving businesses uncertain about future developments. This uncertainty creates significant risks for strategic planning, impacting industries ranging from manufacturing to consumer goods. The complexities of valuing Western assets in Russia remain significant. Offshore structures and tax havens obscure holdings, complicating precise valuations. For instance, stakes in energy projects involving companies like Rosneft and Gazprom often involve intricate ownership structures. Additionally, some firms continue operations through subsidiaries or alternative arrangements, potentially undervaluing or hiding assets through legal mechanisms. Approximately 1,400 international companies are still active in Russia, often relying on convoluted organizational setups. This persistence reveals the challenges of exiting a market intertwined with global supply chains. A confidential Russian decree allowing the discounted purchase of Western assets underscores the likelihood of unreported holdings. Multinational subsidiaries and volatile market conditions further cloud the valuation of these assets. The use of C accounts to retain profits locally and other financial controls point to underreported or hidden assets. Valuations are also skewed by the current sanctions regime, suggesting that the actual value of Western holdings may be significantly higher than reported. For local economies, these hidden assets could mean continued employment for workers, but also heightened uncertainty. Major Western investments at risk include $50 billion from the Netherlands, $19 billion from the UK, $17 billion from Germany, $16 billion from France, and $13 billion from Italy. European companies are particularly vulnerable due to their larger exposure in Russia compared to U.S. firms. Many businesses that initially pledged to exit after the 2022 invasion of Ukraine now find themselves trapped by bureaucratic and financial hurdles. A decree signed by Putin has authorized the confiscation of Western assets to offset losses from frozen Russian holdings abroad. These actions highlight a precarious balancing act for companies weighing reputational risks against operational feasibility. Russia has framed these actions as a counter to what it terms Western thievery. For instance, in June 2024, US and UK authorities sanctioned Russia's National Settlement Depository, NSD, leading to a restructuring of Russia's custody system. By October 2024, Russia removed the NSD from its custody chain for Western shares, instead transferring them to local registrars under Presidential Decree 840. This new system has further trapped Western assets, requiring government approval for any transactions. The move also complicates the ability of multinational firms to execute financial strategies, adding layers of uncertainty. The EU's latest sanctions package, adopted in December 2024, aims to shield European companies from Russian legal and economic risks. Measures include protections against unjust court rulings, compensation claims for losses, and mechanisms for releasing frozen cash balances. The deadline for divestment licenses has been extended to December 31st, 2025. Providing companies with more time to navigate their exits. However, the ongoing economic conflict has already inflicted significant financial damage on both sides. For businesses operating in critical sectors like pharmaceuticals and energy, the extended timelines offer limited reprieve amidst complex geopolitical risks. Russia's national settlement system now controls an estimated $288 billion in Western assets, while the G7 has frozen approximately $300 billion in Russian sovereign assets. Of this, $220 billion is under European jurisdiction. The disparity between state-level freezes by the West and Russia's actions targeting private companies highlights an asymmetry in their strategies. While Western actions leverage sovereign assets, Russia's measures primarily affect corporate interests, resulting in different scales of impact. This divergence reveals differing philosophies in economic retaliation, with both approaches yielding long-term consequences. Russian retaliatory measures continue to escalate. Recent actions include placing companies like Bosch and Ariston under Gazprom's management and enforcing stringent exit conditions for Western firms. These measures include a mandatory 50% discount on asset sales, a 15% exit tax, and approval from government commissions. The EU's latest sanctions package includes further protections, such as prohibiting enforcement of Russian court rulings that impose unfair penalties on European companies. Enhanced mechanisms for managing frozen assets aim to ease the burden on businesses. However, the political landscape suggests that economic standoffs could persist. The December 2024 sanctions package provides a clearer framework for European companies to plan their exits. Extended divestment deadlines and case-specific derogations offer flexibility, but the risks of maintaining operations in Russia remain high. Companies are advised to reduce their exposure due to the growing likelihood of asset seizures and legal complications. The new measures underscore the EU's commitment to supporting businesses in navigating these challenges while minimizing losses. However, this commitment does not eliminate the cascading effects on supply chains and downstream industries reliant on Russian resources. From a legal perspective, the EU package strengthens safeguards for European companies, including protections against anti-EU injunctions and compensation for losses caused by Russian actions. Mechanisms to release frozen assets provide a lifeline for businesses planning orderly exits. Transaction bans and prohibitions on enforcing Russian court rulings aim to create a more secure operating environment. These measures reflect a concerted effort by the EU to mitigate risks for its companies while encouraging disengagement from the Russian market. Yet, such disengagement is fraught with operational and reputational challenges. The broader geopolitical implications of this economic standoff are profound. While the West's asset freezes represent a powerful economic lever, Russia's actions against private companies underscore its willingness to target corporate interests in retaliation. This asymmetry highlights the different priorities and capacities of each side, with ongoing legal proceedings and policy debates likely to shape the outcome. A key decision expected on December 25, 2024, could have significant implications for Western businesses operating in Russia. This decision could also set precedents for how global economic conflicts are managed in the future. The weaponization of the US dollar and global banking systems has led Brics nations to pursue economic strategies that reduce dependency on dollar-centric systems. Efforts to create a Brics currency have gained momentum as these nations seek greater financial autonomy. Although still in its infancy, this initiative could redefine international trade by enabling transactions outside the dollar framework, signaling a shift toward a decentralized financial order. For citizens, such shifts could impact currency values and the cost of imported goods. China, as a leading Brics member, has been at the forefront of these efforts. The yuan's role in global trade has expanded, particularly in energy transactions with countries like Russia, Saudi Arabia, and Iran. Through initiatives such as the Belt and Road Program, China has promoted yuan-based financing and trade settlements, encouraging partner nations to diversify away from the dollar. These steps represent a broader push for financial independence within the Brics bloc, aligning economic policy with geopolitical strategy. The transition to a more decentralized financial system remains a long-term process, but the groundwork has been laid. By prioritizing economic self-reliance, Brics nations aim to reduce vulnerabilities exposed by the West's use of financial sanctions. While the immediate impact may be limited, these developments highlight an emerging shift in the global financial landscape, with potential ramifications for decades to come. The changes could ripple across industries, affecting everything from commodity prices to consumer goods. This economic standoff has raised questions about the sustainability of existing financial systems and alliances. Emerging economies are keenly observing the interplay of sanctions, countermeasures, and currency reforms. The pursuit of alternative financial mechanisms underscores a broader attempt to create a multipolar financial order. These efforts, while nascent, could reshape global trade and economic relations in unprecedented ways, offering new opportunities and challenges for all stakeholders. For ordinary citizens, the stakes include potential shifts in employment, inflation, and access to global markets. The ongoing situation also raises questions about the resilience of global supply chains, particularly in sectors like energy and food. European companies reliant on Russian resources face disruptions that could result in higher costs for consumers. Similarly, energy prices in the EU may fluctuate as nations look to diversify away from Russian oil and gas. These shifts emphasize the interconnectedness of economies and the far-reaching implications of geopolitical conflicts on daily life. Furthermore, the broader impacts on emerging economies should not be overlooked. Countries in Africa, Latin America, and Southeast Asia often depend on affordable food and energy imports. Disruptions caused by sanctions or retaliatory measures could exacerbate economic instability in these regions. This highlights the importance of creating a balanced approach to sanctions that considers global ripple effects. Ultimately, this economic standoff underscores the fragility of global interdependence. While efforts to establish new financial systems, such as those pursued by Brics, signal a move toward resilience, the transition will not be without hurdles. The coming years will likely see a redefinition of economic alliances, trade practices, and financial systems. Stakeholders at every level must adapt to these changes, finding innovative solutions to protect their interests while contributing to a more stable, global economy. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.